I'm James Robinson from Lloyds Development Capital. We're the private equity arm of Lloyds Banking Group. I joined LDC roughly about 3 years ago in 2008. Previously worked with Lloyds Bank in various areas in group strategy and in corporate banking, also a bit of time in retail. My current focus is actually on originating deals, so looking for new opportunities for us to invest in the sort of 10 to 300 million space, and I focus on the Midlands and the North regions.
My name is Steve Real. I'm currently an investment manager at Midven. I was previously an investment manager at the Advantage Creative Fund, which was a venture capital fund based in the West Midlands, investing in creative sector businesses. Before that, I worked as executive director of an international music trade association in the United States for 6 years. And I have the rare distinction of working in private equity and not being an accountant. So.
I was asked by Isabella kindly to come and speak to you today, and the key theme was about sort of trends in the banking market. Now, obviously we both work on the equity side of finance, but I've sort of spoken to a number of my peers over at the bank in various sort of commercial and corporate banking areas, and so try and give you a quick theme for sort of what's going on in the banking market, what the appetite is to lend at various sizes at the moment. But as sort of general themes, sort of 2008, 2009 is obviously a very tough time in terms of attracting debt. Loan tenors, so that's the length of time that money's lent for, was decreasing. But the positive side of that is actually now that's sort of starting to turn around, and we're seeing more and more longer term lending happening from the banks at all levels. There is a significant volume of sort of lending to be refinanced over the next couple of years, which, so on the flip side of what I just said, is also letting banks remain selective. So I'm sure that some of you have come across various challenges when you're trying to fund sort of your growth strategies recently. Positively though, downward trends on pricing, so there is more competition back in the debt markets. The banks are now back, and most of them will say they're open for business. Most of them actually are open for business again. And I think that obviously larger corporates are getting much sort of cheaper debt financing, and it is actually catching up in the SME and smaller businesses markets now. Banks aren't just looking at a customer as a one-trick pony now. They're looking for how much share of their wallet can we get. So they're not just looking to lend to a business, but they really want to understand, what else can we give you? So, can we do invoice discounting? Can we do some forex hedging? What else can we actually get in terms of ancillary business? And that will actually help you in terms of attracting debt at the first stage. So in terms of the market sentiments, and this is based on a survey that was done by the Bank of England to sort of test market sentiments across businesses in the UK, and the results were published back in April. So in terms of businesses' investment intentions, in the manufacturing sector, which I assume some of you guys will clash yourselves in terms of sourcing stuff from the Far East in particular, there's a growth in investment there which seems more robust than the service markets. So businesses are still looking to invest in their businesses for growth, which is positive. Focusing on export markets, businesses are looking to expand their capacity to focus on the rising foreign demand. There's a lot of money flowing in, trying to buy UK products now due to exchange rates and the rest of it, and we're becoming more competitive as a region. New product development is also a big focus as well, so businesses are starting to spend a lot more on developing those new products for some rapid growth markets, and obviously a lot of sort of going back to sort of technology points made earlier, a lot of sort of new high-tech things that people are investing a lot in. Focusing on the domestic market though, it does feel like businesses are still looking to invest, looking close to home, so actually investing in increasing their own efficiencies rather than the new product development that we've just mentioned. And in terms of the credit environment, I'm not sure how you're all finding it, I've already said this, but large firms continuing to report that they have had access to credit if they need it. And again, competition in the market has seen the rates on the borrowing come down. SMEs who've got a significant holding of assets, strong balance sheets and good cash flows have also reported that they're seeing the availability of debt coming back round as well. But a lot of SMEs, and I'm sure that some of you echo this, have remained frustrated with their current banking relationships, and they're increasingly having to look for different sources of finance to support their growth strategies. And hopefully that's where we can give you a bit more information about your sort of venture capital and private equity and where they might be able to support those strategies.
Clearly there are a number of challenges still for SME market in terms of accessing finance, and venture capital and private equity are real options and alternatives at the moment to consider. Just to give you a brief background of Midven, we are a private fund manager established in 1990. We're a commercial, successful business in our own right. We've gone through an MBO in 2007. We focus on managing early stage and venture capital funds. Explicitly, that's our area of expertise. We currently have a portfolio of 63 companies, and that's very important for us. We get a lot of broad sector experience. We have a lot of experience of working in companies in different sectors, facing different challenges, and we try to share that experience across our portfolio companies. We're Birmingham based, and there are 12 of us on the investment team. We're actually the largest investment team of private equity or venture capital in the Midlands, and we focus on investments up to £500,000. Just in terms of our approach, it's very important when you're investing at early stage that you and venture capital level that you understand that this is a long-term capital growth. We're investing for the long term. We're not going to be knocking on your door after 18 months asking where our money is and how can we get our return. So we typically take 5 to 7 year view of our businesses. We understand that there will be a bumpy road, there will be a change of business model, there will be changes of management teams. Those things happen in small businesses, and we've worked with management teams to make sure that those things eventually lead to a strong capital growth. We always take a minority stake. So we're not going to own your business. We do not want to own your business. We do not want to run over 120 businesses. We want you, as the owner-managers, the experts in your sectors, to run the businesses. And we incentivise management teams by making sure that you have a bigger stake than us. If we do well out of an equity investment, you have done even better than us, because you own more of the business than we do.
So in terms of our investment size, one of the key differences is we look at slightly more developed businesses. So we look to invest anything from 2 to 125 million of equity finance. We do tend to focus more at that lower end, so I think our average cheque size is between 5 and 20 million pounds. We have done a couple of larger deals at that top end. And also, we're very keen to support acquisition strategies. So a lot of our businesses receive follow-on funding for acquisitions, to help develop the business. And that's something we're very keen to back management teams that we've already invested in once. We're a regional private equity player, so we've got 11 offices in the UK. I sit in our Birmingham office, and there are 10 of us that operate across the Midlands. We have offices in London, in Leeds, in Manchester. We also opened up an office in Hong Kong about 2.5 years ago now, and that's not actually to make investments, but it's actually to support our portfolio companies. So I imagine some of the people in this room will probably source things from the Far East or even sort of have JVs and what have you over there. Now we've got a team of 5 people out there whose sole job is to try and support the companies in helping their sourcing, in improving their margins from the factories they work with. So that's quite an interesting differentiator for us. We've also started to support some of our companies selling out in Asia, which is obviously a massive untapped market for quite a few small companies. So in terms of some of the deals we've done since 2009, as I say, we have been the most active house in that period, and some of these names you'll probably know. Antler Luggage is one that I'm sure you're aware of. We've done an awful lot with those guys in terms of helping their sourcing in the Far East. Mountain Warehouse, again, do a lot of stuff there. They source products in the Far East. That's sort of a cheaper sort of black's leisure. They do outdoor clothing and tents and what have you. You can see we have really invested across a range of sectors. I think one that some of you may be aware of is a business called Model Zone, which we invested in, which is sort of things like your aeroplanes and your sort of remote control sort of helicopters and all boys' toys, that sort of stuff, all the way through to the craftwares and what have you. One of the other things we've actually, which I suppose is might be more relevant, is we've actually set up something we call our shipping group. So any company now that ships for anything from over in Asia or the Far East, people like Antler, people like Model Zone, they actually share containers together. So obviously can help them save costs a lot on things like that. So we're always trying to work out ways that we can help our portfolio companies work together. So in terms of equity investors, and I suppose this counts for myself in private equity and also in terms of VCs, what are we looking for? So what are some of the things that we look for in businesses? Top half of this, I suppose, is more LDC, but UK based and headquartered. Doesn't matter if sort of 90% of operations and even sales are abroad. We just like the management team to be in the UK, because obviously we like to have the strong relationships with the management teams. Growing fast, ambitious management teams. We always like to back people that are going places. Cash generative is always helpful, but it's not a must. And special, we've already touched on this quite a bit. So any business that can show they've got some real competitive differentiation will be interesting to us.
I think from Midven's perspective, we would agree with most of those things. Obviously, we're looking for high growth businesses, ideally in a market niche. We are investing in the people, obviously, but we don't need necessarily a complete management team. More often or not, for example, there may not be an FD in the business, it could be an owner manager who's grown the business, very creative individual. So that FD support is something that can often come later.
And then in terms of LDC, you know, a more established business usually than Midven, so typically annual profits of £1 million, but we do look at slightly smaller than that at times when there's an interesting growth story. I think below that are just some of the hooks that we look for in terms of, you know, where that might be an opportunity. And obviously you've got your usual succession issues. You've got any business that's actually got some venture capital in there or some funding in there which might need to grow more than that can support it through. But I think the main thing at the moment is that, we've touched on it, is that there has been a gap in the market where the debt finance hasn't been there. So any business that sort of needs funding to support their growth that hasn't been able to get it from the banks, and also any business that I suppose might be able to benefit from some of the expertise that someone like a Midven or an LDC could bring to the table in terms of growing the business, then that's really what we look for in opportunities. So conclusions then. Debt funding, I've touched on this obviously. Banks' lending appetite is definitely coming back. Margins are shrinking, tenors are increasing, which all sounds positive. But we all know that banks do remain selective, and so businesses are sort of having to look for, first of all, banks are looking for more than just lending from their customers, so they want to do more for you, and that'll help. But at the same time, SMEs and smaller businesses are often being frustrated by the lack of debt funding that's available to them.
VC houses, PE houses are very actively investing at the moment to support businesses. We're backing management teams to really help them achieve growth strategies, looking at, you know, identifying those market niches and spotting where those growth trends are going to be. And really it's all about focusing and maximising shareholder value. You know, we want a capital growth out of this business, so at the end of exit, everyone, including the management teams, can be you know, exit beneficially.
Yeah, and then overarching themes, I think, in terms of the debt and the equity finance, and this is probably teaching you to suck eggs, but there is still capital both at the debt side and in terms of the equity side available to businesses which have strong management teams, realistic growth plans that we can buy into, and obviously they can show that they've got some form of competitive differentiation in their markets. And that's about it.